Welcome back everyone to the Audacious Money Witch channel where we talk about investing and trading and a lot of fun things. In my last video, I explained Rivian got a $5 billion investment from Volkswagen Group from Germany, which owns Porsche, Lamborghini, Audi, Bentley, and Volkswagen. And I talked about the macro environment we are facing, and so does the auto companies are facing. High interest rate, sticky inflation, and inverted yield curve. Yes, it still matters. In this video, I'm going to explain why Volkswagen's huge move will ignite the second leg of EV boom, why I believe Tesla stock could break out from the resistance and go on to make higher highs. It obviously depends on August 8th and why I am not as bearish towards Tesla as I am towards Rivian. Why am I not worried that the joint venture of Volkswagen and Rivian could be a huge threat to Tesla? Why I will use my Rivian's profit to invest into more Tesla stock. Tesla shareholders recently voted to reinstate CEO Elon Musk's controversial $44.9 billion pay package after a Delaware judge struck it down. The outcome of that vote has shareholders focused again on Tesla's future. Musk recently spoke ambitiously about that future, which he intends to include full self-driving technology and humanoid robotics opportunities he believes are worth trillions of dollars. As exciting as that sounds, Tesla has struggled recently. Sales of its electric vehicles are slumping, and the stock has fallen 55% from its peak. Investors face the dilemma of balancing Tesla's current state against its future potential. However, Tesla's latest bold move in artificial intelligence, AI, is a major step toward that bright future and arguably makes the stock a buy today despite the company's slowing EV sales. Play to win or don't play at all, Musk said on X that Tesla is building an AI supercluster that once complete could be the world's largest. Musk said Tesla is aiming for a facility that can draw more than 500 megawatts of power. Megawatts, of course, are not a direct measure of computing power, but in case of bigger data centers, the amount of electricity they can pull is what sets the upper limit on how many processors and machines they can have running simultaneously. And 500 megawatts could make Tesla's supercluster one of the world's biggest data centers. Musk says its processing hardware will be split roughly evenly between Tesla's own AI hardware and third-party chips from NVIDIA and others. Musk has made bold claims in the past, especially in terms of the timeline for new product releases. Many releases have taken longer to come to fruition than what he originally anticipated. Still, building this supercluster makes a lot of sense, even if one were to take the above timeline with a grain of salt. Both full self-driving technology and Tesla humanoid robotics will require AI technology to interpret surroundings and react intelligently. Tesla's FSD technology progressed immensely with version 12, which utilizes neural nets powered by NVIDIA hardware versus coded programming. That shows the impact of having sufficient computing power to undergird these demanding applications. If Tesla is ever to deliver on its FSD and humanoid robotics ambitions, it will need a lot more computing power. So constructing this facility is a significant step in the right direction. Electric vehicle down cycle investors should avoid getting lost in the clouds of potential. The reality is that Tesla's financial health today depends on it selling EVs, and business isn't great. Its revenue growth has stalled out despite price cuts that have cut into its profit margins. Seeing Tesla's EV sales slide may be unnerving for shareholders, but such periods come with the territory. Tesla, like most cyclical businesses, is sensitive to the economy. Vehicles are big ticket items that people are less able to spend when money is tighter. Today, the household savings rate in America is near a decade low, and the Fed's hikes to the federal funds rate have in turn helped push the interest rate on the average auto loan to 9.5%. Fortunately, the long-term forecast for EV adoption points to healthy expansion over time. Additionally, Tesla is a financial juggernaut compared to most of its competitors, so a downturn could actually work to its advantage. EV startup Fisker filed for bankruptcy just days ago. Tesla's growth may pick up again over time as consumer financials recover. By then, who knows how much these tough times will have weakened competitors. Tesla's EV sales slump doesn't seem to be of concern to analysts. The consensus estimate is for the company to grow its earnings by an average of 22% over the next 3 to 5 years. Tesla is notoriously polarizing, but buying the stock likely means you believe that Musk will continue creating value for shareholders. After all, the stock has obliterated the broader market since the company went public back in 2008. It's hard to call Tesla cheap, trading at more than 74 times its estimated 2024 earnings, but cyclical stocks always look expensive during the falling parts of their cycles. Even with its volatile past, the reality is that this stock rarely drops more than 50% from its high. Investors who believe in Tesla's capacity for innovation and its ability to monetize it should consider buying shares if you don't own any. Its progress with AI and its supercluster plans could easily get Wall Street back on board, even as its EV business slumps. That said, don't be reckless, because based on the Tesla chart, so if this was our A wave down and the B wave bounds, then as long as Tesla stays below resistance, this is my higher probability wave count. As long as we stay below 205 or even let's say 200 moving average, this is the likely C wave down. And I think within the C wave, which will take us eventually to retest the lows of 2023, I will be buying more shares at this levels. But if August 8 went well, then we are going back to all-time highs. Don't get me wrong, I do like Rivian's product. They look sick. They are always impressive performance-wise. It's just Rivian's cash burn is off the chart. Even after they joined with Volkswagen, it's hard to imagine they can make drastic improvements in their negative gross margin. That's the first reason I am not worried that Rivian, as a competitor to Tesla. The second reason is Rivian, like Tesla, is focused on EV purely. They don't make hybrids.
Imagine if we were born with two hearts. How would life change? Would we be faster? If we had two hearts, would we enjoy more? If we had a hybrid heart, would we be able to choose which heart beats and when?
Plug-in hybrids are getting popular, and people are understanding that they can plug it in and get all-electric range, but they still will be fine if that range is used up. Hybrid vehicles have been a surge in buyers over the last year. Sales jumped 65% to hit 8.3% of total new vehicle market shares in 2023. Hybrid models also have another benefit. They retain more of their resale value in the used car market. Popular hybrid models like the Toyota Prius kept about 70% of their value after 5 years. The Tesla Model 3 held about 53% of its value in that same time span. I am not worried about Rivian and Volkswagen so much as Toyota is taking more shares as they are a dominant hybrid player. On the other hand, Tesla is not just an EV company. We are betting on bigger and better things like Robotaxi Network and Optimus Real AI Robot. This is why I sold my Rivian shares to buy more Tesla stock. Subscribe to find out when I buy those shares and at what price.